Hello everyone. Today I will be talking about surety bonds, what they are, how they work, their differences with bank guarantees, the challenges and benefits involved, and the future outlook of surety bonds in India. Understanding this financial instrument is increasingly important, especially in sectors like infrastructure, construction, and trade.
A surety bond is a legally binding contract involving three parties: the principal, the obligé, and the surety. The principal is the individual or business undertaking an obligation or project. The obligé is the party requiring assurance that the principal will fulfill their obligations, often a government agency or project owner. The surety is a third party, usually an insurance company, that guarantees the performance or obligations of the principal to the obligé. If the principal fails to meet their contractual duties, the surety compensates the obligé for any losses up to the bond amount. The principal is then obligated to repay the surety. This creates a risk management mechanism protecting the obligé while enabling the principal to access opportunities without tying up their working capital. Difference between surety bond and bank guarantee. While the surety bond and bank guarantee serve similar purposes as financial assurances, there are key differences. Issuer. Surety bonds are issued by insurance companies specialized in risk assessment, whereas bank guarantees are issued by banks. Collateral. Bank guarantees usually require the principal to provide collateral or margin money, which restricts the principal's liquidity. Surety bonds do not require collateral, allowing the principal to preserve working capital. Risk approach. Banks act more like lenders, so they have strict eligibility criteria and limits. Surety companies focus on underwriting the principal's risk profile and financial stability. Impact on credit. Bank guarantees can reduce the principal's borrowing capacity as they tie up credit lines. Surety bonds do not affect the credit lines of the principal in the same way. This makes surety bonds more accessible for small and medium enterprises looking to qualify for large projects without compromising cash flow.
Challenges in bank guarantee issuance. Issuing bank guarantees involves several challenges. High collateral and margin money requirements lock up the principal's funds. Banks use rigid credit assessment models, making it difficult for newer or smaller businesses to qualify. Legal clauses in bank guarantees can be onerous and harsh for principals, such as auto-invocation clauses. The process can be slow and administrative heavy, affecting project timelines. The financial risk banks take leads them to be extremely selective, limiting market access. These challenges limit the use of bank guarantees, especially for MSMEs and emerging businesses.
Benefits and drawbacks of surety bonds. Benefits. No collateral needed, preserving liquidity and working capital for the principal. Quicker and simpler issuance process. Enables more businesses to participate competitively in projects. Obligees benefit from specialized risk management and financial assurance. It frees credit lines, enabling business growth and operational flexibility. Drawbacks. Coverage is specific and may exclude some risks like fraud or insolvency. Potential risk if the surety company faces financial difficulties. Regulatory compliance and understanding of specific bond terms are necessary. Not yet as widely recognized or understood in India compared to bank guarantees. The way forward for surety bonds in India. Surety bonds in India are at a transformative stage. The market is growing rapidly, driven by government infrastructure projects and demand from the private sector. They offer a powerful alternative to collateral-heavy bank guarantees. Technology-driven platforms are making issuance more accessible and efficient. Increased awareness is essential among businesses, banks, and regulators. Regulatory support and frameworks will help build trust and market depth. Surety bonds could be a key enabler for SMEs and startups to participate in large projects, boosting economic growth. In summary, surety bonds provide a flexible, efficient way to guarantee project performance and financial obligations without the heavy collateral constraints of bank guarantees. While challenges exist, the benefits are compelling, especially as India's infrastructure and business environment evolve. Embracing surety bonds could drive greater financial inclusion, project success, and economic opportunity. Thank you for your attention. I hope this has provided a clear understanding of surety bonds and their importance in the financial landscape.